Good morning, ladies and gentlemen. Volkswagen AG would like to welcome you to this conference call on the first quarter financial results published by the company. Please note that this conference call is being recorded. I would now like to hand the call over to Nicole Mumson, Head of Global Group Communications. Thank you.
Thank you, and good morning, everybody. Welcome to our first quarter conference call of the Volkswagen Group. We already released figures early in a regulatory statement, as you have all seen. So today we are diving a little bit deeper into the background of those earnings. And with me, I have Herbert Diess as our CEO and Arno Antlitz as our CFO. And I will hand over right to Herbert Diess. In the aftermath of the speeches, we will have time for your questions and answers. Thank you. And with that, over to Herbert.
Yeah, ladies and gentlemen, welcome to today's conference call on the results of a strong first quarter. When we look at the figures today, you can still see why we entered 22 with optimism. The global corona pandemic seemed to be over after 2 years, the supply situation for semiconductors improving from month to month. On February 24th, the war in Ukraine started, which is now 10 long weeks ago. In Europe, we were short of wiring harnesses from one day to the next. Around the world, prices for key raw materials have soared due to the inflationary environment. I will come to the impact on our business in a second. At the same time, there are new tough COVID lockdowns in China, which have put a lot of pressure on our supply chains. In Q1, we were able to mitigate these extremes. In comparison to the first quarter of 21, we kept sales revenue stable and slightly increased the operating margin, even though we delivered 340,000 vehicles. A strong quarter. This is true even if you factor out the effects resulting from our successful hedging against price increases for raw materials. Arno will give you more details on this in a moment. Regarding our deliveries, our e-cars are sold out for this year and are still very much in demand. The order backlog in Western Europe alone are around 300,000 vehicles. We just presented the ID. Buzz to the public with outstanding response. Despite supply bottlenecks for semiconductors and cable harnesses, we delivered 99,100 EVs. The biggest increase was in China, where we delivered 28,800 electric cars. You can see that our group has shown resilience. As a global company, we have extensive production capacities in the relevant growth and sales markets worldwide. Volkswagen's global setup helps us to mitigate many of the adverse effects we are currently seeing. Operating globally in open markets is essential for us as a company to become a world-leading provider of sustainable mobility. The increasing formation of old and new blocks would have a negative impact not only on us as a company, it would diminish prosperity and slow down innovation and progress, in particular in Europe and in Germany. We need decisive political action so that in the long term, a world of political dialogue, economic cooperation and free trade will become our common goal again. Therefore, the midterm strategy for us is clear. Our setup will be even more global, particularly with regards to the US. We will implement an ambitious growth plan. In China, Volkswagen will maintain a high pace, accelerating digitalization and electrification. America is our chance for strong strategic growth. Our BEV market share is already twice as high as our ICE market share. In Chattanooga, we are to launch the locally assembled ID.4 this year. Because of our successful e-mobility ramp-up, we have discussed to expand our production capacities there. We have committed $7.1 billion to boost Volkswagen's product lineup, R&D and manufacturing in North America, and we are sourcing and producing 95% of all cars for the region in the region. This makes us fast, flexible, and resilient in our supply base. In China, 28,800 BEVs had been delivered in Q1, more than 4 times as many as in the first quarter of last year. This represents almost 1/3 of the group's worldwide BEV deliveries. With Audi FAW, we agreed in January to build electric premium cars in Changchun from 24. And we are expanding our location in Anhui into a hub for e-mobility with a new development center. From now on, we produce software in China for China to better tailor the user experience of the group software to the needs of Chinese customers. CARIAD has just started operations in Beijing with already 600 employees. From summer, Ralf Brandstetter, as a new board member, will make sure that we take a cross-brand, cross-platform approach in China. We adapted to the dynamic market environment with immediate action. First, we were fast in finding solutions for a pressing problem. The lack of wiring harnesses, the task force team started to work on February 26, only 2 days after the beginning of the war. Second, our hedging mechanisms against raw material price increases have taken effect. The extent of the risks we have to be able to reduce, at least in part, can be seen on our balance sheet. Third, we focused on higher margin products to help offset overall production decline. And lastly, we used our position as a truly global company to balance production across our markets and relieve pressure where there were supply issues and product shortages. For example, when we had to cut back production in Europe due to a lack of wiring harnesses and in some areas had to shut down plants, we sent the semiconductors we didn't need to other regions. In this difficult market environment, we are continuing to drive our new auto strategy forward. We are evolving from a classic OEM to a vertically integrated mobility company. In a recent board offsite, we agreed that a new group setup is mission critical for this. In a new auto world, our competitors are no longer called Mercedes, Toyota, or Stellantis, but Tesla, Foxconn, Apple, LG Electronics, or Uber. Our brand groups will have to become more independent, getting involved in their operational business and without the group getting involved in their operational business, instead focusing on overall strategy and synergies. We are mirroring the brand group approach today in our first quarter earnings report. Particularly, the Volkswagen brand will get more power and become fully self-sufficient. Only strong lead brands can build powerful brand groups and leverage economies of scale. Our platforms will also get more autonomy to ensure we can maximize synergies across the group. In Q1, we have seen milestones in these platforms. Together with Ford, we have expanded our e-mobility partnership. Ford plans to produce another electric model for the European market based on the MEB platform. They will also double its planned MEB volume to 1.2 million units over a 6-year timeframe. Our new travel assist has caught up to our competitor systems, bringing the feeling of autonomous driving closer than ever before. This quarter, CARIAD took over IP from Bosch to accelerate the development of autonomous driving, and we bought the company Intenta to increase the in-house skills for image processing. Our software unit now employs around 5,000 experts. We have published our plan to apply to the Spanish PERTE program. Our goal is to make Spain an e-mobility hub. It would include the biggest investment ever made in Spain, together with external partners along the entire value chain of e-mobility. We announced Valencia as the dedicated location for a new battery cell factory in Spain. All plans are still subject to final approvals, foremost the PERTE submission. And to make charging even more convenient for our customers, we have introduced one charging price model in Europe. One card gives you now access to a network of over 300,000 charging points. We also presented the next step in the development of our autonomous shuttle services as a new source of revenue. From now on, the ID. Buzz, equipped with Argo AI technology, drives autonomously no longer on the test site, but on public roads in the center of Munich. The goal is to have autonomous shuttles by 25 in Hamburg. And we have completed the next steps to take over Europcar as base for building a leading mobility platform for our customers. We are confident to close the deal in Q2. We raised ambition of emission reduction targets in our own production facilities from 30% to 50% by 2030 compared to 2018. This is why Science Based Targets Initiative confirms that Volkswagen's increased climate targets in production are now in line with the 1.5-degree target. These are rather uncertain times. We cannot predict the long-term effects of the Ukraine war on the ongoing COVID-19 pandemic on our business yet, nor the effects on the global economy and growth in the industry in fiscal year 22. But our global setup, our risk management, and our capabilities to act fast when facing new challenges gives us the confidence for 2022. Therefore, we confirm our outlook for the full year. And with that, I would like to hand over to Arno.
Hello and welcome everybody from my side as well. As already mentioned by Herbert, the war in the Ukraine has been going on now for more than 2 months. We are greatly concerned at the daily news about the war and continue to hope for a hold of hostilities and return to diplomacy. Nevertheless, today we would like to provide you with the full picture of the quarter, adding to our pre-release announced from April the 14th. Solid operating result again showed the robustness of our business model in a challenging environment. On top, we benefited significantly from the positive fair value measurement of our commodity hedge portfolio. We continued our focus on mix and margins, and we improved our cost base further. But we made no compromise on future investments to accelerate our transformation towards electric and digital. In Q1, our supply chain faced a threefold challenge. The war in the Ukraine that started on February 24th, impacting global supply chains, a continued undersupply of semiconductors, and last but not least, the resurgence of the COVID-19 pandemic in China, affecting us at the end of March. On the backdrop of these challenging developments, we delivered a set of decent results during the first quarter. Vehicle sales for Volkswagen Group came in at around 2 million euros in the first quarter 2022, 340 units less than Q1 2021. Despite lower sales revenue came in at 62.7 billion euro, on par with prior year. Lost volume has been partly offset by the first-time consolidation of Navistar revenues, ongoing high demand for well-equipped premium vehicles, and favorable pricing. The operating result before special items came in at 8.5 billion euro. The operating margin is 13.5%. This result contains a significant positive impact from positive fair value measurements on hedging instruments outside hedge accounting. In total, 3.5 billion euro, resulting especially from derivatives on commodities and currencies, as stated in our pre-release. Even excluding these fair value effects, an underlying operating profit of around 5 billion euros lies significantly above previous year and underlines the robustness of our business. Clean net cash in Q1 2022 amounted to 2.2 billion euro and reported net cash flow with 1.5 billion euro. This compares well to Q1 2019, both driven by our strong operating business, but burdened by higher inventories due to the supply chain disturbances mentioned earlier. Net liquidity in Automotive division amounted to around 31 billion euro. It includes the repayment of a hybrid bond of 1.1 billion euro in March 2022 and the successful placement of new hybrid bonds issued in the same month for 2.25 billion euro. This again underlines our continued excellent access to financial capital markets. Coming to the performance of our divisions, Passenger Cars delivered 6.5 billion euro operating result and a 15.5% margin before special items. Drivers were especially the strong performance of our premium and luxury brands and of course the effect of fair value measurements we already discussed. Also our commercial vehicles came in higher than last year. The operating result of 330 million now includes Navistar with around plus 80 million euro in Q1. The Financial Services division again had a very strong start to the year with an operating result of 1.5 billion euro. Positive effects were the continued high used car demand and higher prices, a favorable development of residual value risk, and a solid credit risk situation. Let's have a brief look on our newly established brand group reporting. Coming to volume brand group, which contains of brand Volkswagen, Skoda, Seat, Volkswagen Commercial Vehicles, and our component business. Due to the disruptions of the supply chain, sales at brand group level were around 280,000 lower versus last year, especially for VW brand and Seat. Volume brand group had the biggest exposure to COVID, semis, and the Ukraine. Despite that, the group showed a decent start to the year and initiated countermeasures to catch up. However, the margin of 3.6% clearly shows room for and necessity for improvement. The volume group has upside in terms of capturing synergies and increasing productivity. Coming to premium brand group, despite the 16% lower sales and sales revenue are on par with last year. Demand for well-equipped premium vehicles continued. The operating profit as well as the operating margin are up significantly. Main drivers are strong pricing as well as the effect of fair value on commodity hedges. Porsche sold 66,000 units in Q1 2022, slightly down versus Q1 2021. However, sales revenue was up as well as operating profit. Porsche showed an impressive margin of 18.6%. A deep dive into the volume group shows encouraging news. All brands in the volume group saw an increase in average sales price, even though unit sales declined, in part by double-digit percentages. For VW brand, Seat, and commercial vehicles saw an increase in margins. Only Skoda saw a decline in margin as they are consolidating our Russian business and ramping up the factory and our business in India. Now let's come to our outlook for 2022, and to make it short, we confirm our outlook from March 15. This is true for all core KPIs, reported deliveries to customers, sales revenue, operating result for the group, reported net cash flow, and net liquidity for the automotive business. Given all the uncertainties and given that it's still early in the year, we think we are well advised to stay cautious, especially knowing that developments in the war in the Ukraine or the COVID pandemic cannot be predicted with certainty. There is a continued risk that both developments, the Russia-Ukraine war and the COVID situation in China will have a negative impact on the Volkswagen Group's business activities in the current year. Ladies and gentlemen, financially steering the transformation, there are two clear strategic goals: allocating and shifting of resources and capital towards electrification, digitalization, and mobility services. And our second goal is to safeguard and further strengthen our financial foundation. To achieve these twofold goals, we defined 6 major topics: product transformation towards electric, digitalization and developing further our software stack, capturing group-wide synergies between the brands, steering group-wide cost and efficiency programs to finance the transformation, strengthening brand positioning and pricing, and everything we do, we base on our integrity and values. Let me give you a brief glance on where we stand on some of these topics. Volkswagen Group BEV sales in Q1 2022 achieved almost 100,000 cars, BEV share of 5.2%. Despite semi-bottlenecks and wiring harness shortages, 990,000 BEVs were delivered, up 65% year-on-year. The sales figure could have been much higher, as we sit especially in Western Europe on a huge order bank. However, some production disruptions also impacted our BEV production. From where we are now, we anticipate a constantly growing BEV volume and share in every quarter of 2022. The ramp-up of our retooled plants Emden and Chattanooga will drive scale up, global production footprint will help, and new exciting models will be launched. ID. Buzz was launched already. ID.5 has a start in May in Europe. We will continue to increase our BEV sales this year and aim for a BEV share of 7 to 8% in 2022. To finance our ambitious transformation towards electrification and digitalization, we have initiated in 2021 our overhead cost program. Everyone is aware of it by now. We achieved our 2023 target of minus 10% cut in overhead costs already in 2021. So far, we are working to stay on level achieved and to compensate for an increase in fixed costs, and well as to mitigate the first-time consolidation impact of Navistar. Ladies and gentlemen, we have a solid financial basis. This provides us with the opportunity to continue our transformation also in difficult times. We will continue to strive to be a leader in the transformation of our industry. We will preserve our natural resources, and we will achieve this with integrity and based on our values. Thank you for taking the time and listening so far. Now we are happy, looking forward to your questions and answering your questions.
Thank you, Herbert. Thank you, Arno. I'm handing over to the operator for just 1 second.
Thank you. If you would like to ask a question, please press star 1 on your telephone keypad. If you find your question has already been answered, you may remove yourself from the queue by pressing star 2. But again, please press star 1 to ask a question.
Thank you. And we have Christoph Steitz from Reuters with the first question.
Yes, good morning. A couple of questions, one on energy more broadly. The EU has just basically confirmed that there will be an oil embargo on Russian oil imports into Europe. I mean, more broadly speaking, is there any sort of fallout that you see for the VW Group specifically related to energy imports from Russia? And have you made any sort of contingency plans to offset those impacts, if there is one? I mean, I think the same would apply for gas further down the line. If you could just comment on that, that would be very helpful. The other question would be more broadly on strategy. I mean, you found your structural answer to the challenges of the automotive industry by listing Porsche later this year. I would still like to get your take on what some of your rivals are doing more generally. This whole idea about a BEV ICE split, is that something that you've considered for your business? And if so, why have you not followed through on that? Any thoughts on that would be welcome. Thank you very much.
Okay, that's probably me being addressed. Energy supply from Russia, yes. So we are concerned about the threats there. We are in the midst of a transition from coal-fired power plants to gas, which is basically executed. So we would be prepared to gas. But understanding the situation, we just decided to upgrade our coal-fired power plants to still be able to use coal or gas, however the supply is going to happen. This refers to our main operations here in Wolfsburg. Yes, we are trying to be as resilient also in the supply. we cannot really fully judge what's going to happen in our supply chain, because if there would be really a cut-off of gas, but we're trying to be as resilient as possible. Our energy consumption in the car manufacturing plants are not so high. Most of it goes into the paint shop, and I think we are quite resilient there. But actually, really a shut off, a cut down of gas would potentially harm the German economy quite substantially. More generally, the BEV ICE split is something we are not considering because, as you know, we're basically making use of leveraging our structure. So we convert plant by plant, we electrify all our brands. And we think that this approach of making best use of the assets of the ICE world to be fast and competitive in the electric world is for us the best way forward, and it's working out well. We have now converted Zwickau fully to electric cars. We're also preparing a more transparent reporting on the margins on our EV business, where Arno might comment a little bit. And we are closely looking at the development of our EV business, so we have detailed figures, we compare market shares, and we feel well on the way. We have been disclosing the figures of China, where we have been able to fourfold our EV sales compared to last year. So we have a higher market share on the EVs, generally speaking, than on the ICE. So we think well on the way, and we think that we disclose the right figures for yourselves, that you can judge whether our EV strategy is working. I think we have some very positive feedbacks on the new models, so we think we are well on the way with the EVs. The ID. Buzz now just being introduced to the public in the United States, in Europe. We have extremely good order intake on the EVs, still higher than last year on the EV side. And we have the order book is really, we are basically sold out on EVs in Europe and in the United States and in China. It's really picking up. So, yeah. But we don't consider really to separate both businesses.
Okay, thank you.
Thank you. And then we have Joe Miller from the FT.
Yeah, thank you. Good morning. Did I hear correctly? Did you say you're sold out for BEVs for 2022? If so, can we get a little bit more detail on that? Is that worldwide? And what does that mean? Does that mean that you have a figure of maximum production based on the current bottlenecks that you don't think will ease? You mentioned 7 to 8% of the BEV share. That would be roughly 700,000 this year. Is that what you're assuming? And you have more orders coming in than that figure, or have I got that wrong? So just a little bit more color of what that means that you're sold out of BEVs. And just secondly, very quickly on the China lockdown, is that primarily a production issue, or are you also missing parts because of those lockdowns? Thank you.
Yeah, Joe, you basically what you said is basically right. So we already in some markets, no, it depends on the markets, but in some markets we are already selling model year 23, and which means we have very high order books and still high order intake on the EVs, and that is the case for Europe and the United States. Although in China it's really picking up. We have good order intake, and the cars are getting very good market acceptance. So yes, and you say it's about 700,000 units. That's the figure we are aiming towards the end of the year. So it means once again closely to doubling up EV sales. That's exactly where we are, and we feel very well on the way. That accounts basically for all our models now from ID3, ID4. The Audi models have been extremely well received in the market. So Q4 e-tron, Skoda models are also extremely well received in the European market. So we think we are really well on the way. And the bus is really also, I think, a very positive signal because, bus is being launched now with the next generation of software, which we call 3.0 version of the 1.1 platform software. And it brings a lot of improvements when it comes to driver assistance functions. Some of the external testers really think we have there already a competitive advantage in some of the markets over our most impressive peers. We are working with swarm data, upgrading the software continuously. So I feel also now very good on the software of the MEB vehicles. Speech control is working really nicely. And that's quite unique. We are updating even driver assistance function over the air. No? One thing is that you have a nice screen on a car or an additional customer interface, but driver assistance functions, updating those are really very critical. And we are probably within the first companies to use swarm data and learning from our fleet to improve the functionality of the individual car. So that's quite encouraging. Production in China, the constraint is the shutdown of the plant. There might be one or the other supply constraint as well. Which we are working on, because China also is very complex. We have about 13 assembly plants there and a very complex supply chain. And you can imagine that through China we have different restrictions in some of the areas, or logistics is a problem. But we hope that all China will open up again towards the end of May. And we keep the plants running at lower rates than there has been. So it's both. It's a shutdown of the plants and supply chains.
Thank you.
Thank you. Then we have Jan Schwarz from Reuters.
Hello. Can you hear me?
Yes.
Okay.
Yes, we can.
Good morning to all. I had a technical issue here over. Just two very brief questions. Are you sticking to your plans to IPO Porsche? And when exactly will you decide further and publish further details? And the second one will be on CARIAD. When do you expect CARIAD to make profits? Thank you.
Yeah, no, Jan, we are pursuing our IPO Porsche process and project as planned. As we disclosed already, we hope that it will happen in Q4. All the preparations are on the way, and on the way from here to Q4, there will be, of course, more information, but it's too early to give you now the details. But rest assured, we are pursuing that with high motivation, and we're still very much positive that it can happen in Q4. And also, if you look at the Porsche result in the first quarter, you see how resilient Porsche is. So it's really a great brand. It shows really that the BEV business model works at Porsche. Taycan outsold 911. Porsche had still great margins. So it's the right time to pursue that project.
CARIAD is financially to be seen like a big car project, where you would have a big investment getting into it, and then after the revenues are only coming after the launch of the software. So CARIAD will become profitable beyond 26.
Thank you. Then we have the next question coming from Marco Engemann, DPA AFX.
Yes, good morning. Thank you very much for taking my question. Regarding your plans in the U.S., you said you discussed production expansion in Chattanooga. How much would you need to expand to meet your ambition of 10% market share there? And would this additional capacity completely be in the USA, or is it possible to ramp up production in Mexico as well? And how much, if any, expansion would be fully battery electric? Thank you very much.
First priority is really to step up production in Chattanooga. Chattanooga is what we call basically half a plant or capacity around 150, 200,000 units. And the first measure would be really to double up Chattanooga, which would be a expansion of the paint shop and basically then adding body in white facilities and assembly facilities. What we have under discussion is really focusing on EVs because we think we have the brand works very well with the EVs. We have high demand. Just introducing the ID. Buzz showed us that the Americans love EVs from Volkswagen, are going to love. So the focus will be clearly on electric cars, which we see as an historic chance to gain market share in the United States. Clearly that increase of capacity in Chattanooga would not be enough to get even close to those 10% market shares we are aiming. So we are for sure considering additional capacities. It's not yet decided whether that would be in the United States or Mexico, most likely in the United States.
Thank you.
Thank you. And Frank Johansen from Automobilwoche. Frank, go ahead.
Yes, well, thank you for taking my question. This just one follow-up question to what you just said. Do you already also plan to produce the ID. Buzz in the US? I know your CEO in North America would be very happy about producing the ID. Buzz himself and not importing it from Hanover. And a second question, you already told about independence, becoming fully independent of the Volkswagen brand. Does that include a known company, Volkswagen AG, Volkswagen Passenger Vehicle AG, below the Volkswagen AG? I would think 100% share would be at Volkswagen AG, and then perhaps same with commercial vehicles and components.
That's probably, let me start with the last one. It's probably a misunderstanding. No, we are basically grouping the volume brands together as one entity to make sure that we are leveraging the synergies better, no? Because basically they are using the same platforms. The brands not always have been fully complementary. Now, yes, I think we have a very good brand strategy where Skoda, Cupra and Volkswagen are really becoming complementary in their customer approach, in their product lineup, in their Cupra becoming a really emotional brand. Skoda's new design language which is called Modern Solid, which is also gives room for additional growth for Skoda, and Volkswagen with the typical quality criteria and probably timeless design. They are now being set up really complementary, and the grouping the volumes between light commercial vehicles, Skoda, Seat and Volkswagen should allow us to leverage the main synergies. We're talking then 8 million cars of 10 million cars using basically MEB and MQB platform only, and we're just looking for more synergies, grouping them together. That should work well. That doesn't mean that we have to go for additional or new legal structures. We will not touch the legal structures. The other question was ID. Buzz in the US. Yes, we are considering to localizing the ID. Buzz, but we have the decision is not yet made.
Thank you. Then we have Jan Schreiber from AFP.
Yes, hello. Thank you very much for taking my question. One for Mr. Antlitz, one for Mr. Dies. Mr. Antlitz, you said the average prices have increased even in the volume range. Can you give us an indication of either the increase or what the average prices are that you realize or that you're aiming for? And the second is again on the U.S. You said you're looking at expanding Chattanooga and then looking at a second, maybe a second plant. Did I understand that correctly? In another plant, not a second one, in the U.S. And was this driven by the war in Ukraine and by the sanctions that could hit China at some point, or is this has this been cooking for longer?
Yeah, let me start with your last point. United States of America for long has been for sure the biggest strategic potential for Volkswagen. And Volkswagen tried hard, I would say a few decades. I think we now really have good momentum to make the move and to step up. So we have been investing with, bringing the electric cars, investing in fast charging infrastructure through Americas. It seems to be that we bring the right emotional products with the ID4 being locally produced, the ID Bus being at least exported to the United States. I think we have now extremely good momentum. Also, the conventional product portfolio is really now tailor-made for the US, mostly selling trucks, let's say SUVs mostly. So we have very good momentum, and I think it's now the time to step up our operations. We will use that momentum. I think it's an historic chance to step over into EVs. We are second in the world market for EVs, so it's time to get even more successful in that. We are profitable in the United States, which we haven't been for the last 10 years, and also the outlook for even this year, which will be once again a tough year because of supply constraints, is positive. So it's and we see also the American region as a continuously growing market for individual mobility because there's no real alternative to that. And to be resilient and to be sustainable in the market, we need a much higher market share. No? So with 4%, we are basically still very niche and only premium in the United States. So is it being driven by what happens in the world? Additionally, for sure, because we think America will be basically untouched by what's happening in Europe, and so it's for sure it should be also geostrategically a region where we should invest more.
And the second question concerning average price per car, yeah, the demand for cars in the volume group are really strong. They have great products, and technically there are basically three effects that drove the turnover per car. First and foremost, customers choose higher equipped cars. They ordered more equipment per car, which is a great sign. And second, since the cars are really have great product substance, the volume group gave less tacticals, which also helped the average turnover per car. And there's also a technical effect since we sold a little bit less cars in, for example, the South American regions where we have the cars are not as expensive as in Europe. There's also that is the third effect. But the major driver is that customers choose higher equipped cars, which is a great sign for the volume group.
Thank you. We have one last question for the moment, which is coming from Mark Burton from Bloomberg.
Hi, thanks for taking my question. I was just wondering if you could provide a further breakdown of the gains that you made on your commodity hedges, particularly nickel. And secondly, I was just wondering if you could talk about the cost pressure that you're facing from the rise in some of the other battery raw materials that are harder to hedge, lithium and cobalt particularly. Are we at the point where if these current high prices are maintained, it threatens the profitability of your EV business? And if so, what kind of price increase would you need to push through for consumers to kind of restore your margins?
Mark, I start with the second question. Look, what we said earlier, we basically were planning for margin convergence of electric cars and combustion engine cars in 2 to 3 years, and we basically make good progress. The demand for our electric cars are really high, and so we see really good pricing, less incentives, and we are ramping up the MAB on a global basis. We're ramping up the MAB now in a third factory in Europe. In Emden, we are ramping up Chattanooga. We have 2 factories in China. So basically, the scale of the MAB is really increasing, and that gives us economies of scale and drives costs down. And we made also progress in battery costs. Yes, you rightly mentioned that lately, due to the war, raw materials increased significantly, specifically lithium, but also nickel. We have to monitor that closely. That puts pressure on the whole equation. But as said, on the other hand, we are really making progress on the cost side. We try to compensate as much as possible with cost measures. We also increased our volume further by the cooperation with Ford, which now put a second model on the MAB. So in total, we try to offset the increase in raw materials as much as possible, but we can't rule out that there might be additional price steps in future in order to secure the margin. In terms of nickel, for competitive reasons, we can't really give more details on the hedging, which raw materials we hedge. Sorry for that.
Understood. Thank you.
Thank you. I'll hand over to the operator to ask for any additional questions.
As a reminder, to ask a question, please press star 1. As there are no further questions, I will hand the call back to Nicole for any closing remarks.
Yes, thank you. As always, of course, we'll be around the press office, Christopher, Christoph, and myself for any additional questions. We will have the analyst call in the afternoon. And with that, we would close today's first quarter earnings call and wish you all a good day. Thank you for joining us.
Thank you. That will conclude today's conference call. Thank you for your participation. Ladies and gentlemen, you may now disconnect.